losses for investors. Joining me now is Veracruz LLC founder Steve Cortes. Steve, first off, has this market reached a bottom yet? Should we even be talking about that? Or is this the new norm of this level of volatility?
You know, Sandra, have we reached a bottom? No, I don't think so. And by the way, when we talk about markets, sadly, and this is the reality, we're not so much talking about markets anymore. We're more talking about casinos. And that is what central banks globally, whether it's the People's Bank of China or the Federal Reserve or the ECB, that is what they have created. And that's unfortunately what we as investors have to live with. But even China last night, it only closed down 1%. But by the way, only 1% after falling 17%, I believe, the two previous sessions, despite the fact that the Chinese government cut rates. So that was not in any way a constructive session. It's nice that U.S. futures are trading well pre-market today. Of course, we saw that yesterday. Sometimes that can be the gap that's followed by something much worse than a gap, the gap up, and then very, very hard trade down. But I think, look, markets right now have to start pricing in the fact that global growth is decelerating in a very significant secular way.
Wait, what do you mean the markets have to
priced.
start pricing in that deceleration? I mean, isn't that what this sell-off, isn't that the whole point?
Yes, no, absolutely. And I'm saying the market is starting to do so. Global growth is decelerating, and it's decelerating in a significant fashion. The U.S. is doing okay. The rest of the world is anything but okay. Europe is facing a deflationary crisis. China is in meltdown mode. And I think that, you know, if you have both wings of the global economy, if the U.S. is the body and you have both wings doing that poorly, the body also, sadly, has to give back and has to reprice. We're starting to do that, but I think there's more of that ahead.
John Bussey.
Steve, how does this resolve itself? If it's a casino, because central banks have intervened over the last few years in all of these countries and in all of these markets, how does this ultimately resolve itself? Where does the market stabilize once the central banks begin to get out of the trading business?
Right. Well, no, and listen, that's the problem. Is it's very easy. It's kind of like a casino, right? Very easy to get in, very hard to get out of necessarily. It's a lot of fun while it lasts. And casinos can be great, right? You've got the martini and the smoke going, and you're having a ball, but you leave broke.
Yeah, no, you leave on your back, passed out on a stretcher.
Right. Right. And I think, sadly, that is the problem. And I will tell you this. I don't envy Janet Yellen, even though, granted, the Fed created, in many ways, this situation. But the point is, she's the one who has to try to extricate central banks and certainly at least the U.S. central bank from this financial situation. And there is no easy answer.
Once all that's done, are we 3,000 points lower? Or are we 1,000 points above where we are? Where does it resolve itself?
We are lower for certain, and I think interest rates are dramatically lower, by the way. I think U.S. interest rates are going to go where the rest of the world is. I think we're going to see eventually the 10-year yield break 1%. Right now, you know, we're at 2% roughly and trading around 2% of 10-year yield, which seems incredibly low. I don't think that's low at all, given the global growth situation. Where is the stock market going? Lower is my view. How much lower? I don't know. Targets, I think, are very, very hard. It's hard enough just to get the direction right, much less actually touch on the actual target.
Steve,
to the downside.
That's
look,
the best answer I've heard in a long time, by the way. People are so scared to say, I don't know. And that's the point. You know, if you embrace the uncertainty of it all, you have no idea how this central planning circus or casino
He just said
ends.
he knows that the 10-year is going below 1%.
Yeah, he didn't, but the question was, where does the stock market stop going down? And the question was, does it go down 3,000 points? What you don't know is how these central planners end in panic. We don't know that. That's the point. You got to wait for Jackson Hole. What is Draghi going to do? What are the Japanese going to do? I mean, this doesn't have an end point.
I want to get back to John's point, though. Is you're saying that the markets have not been allowed to function properly or function as they would because of the Fed's level of involvement, and you're trying to imagine what a stock market in the U.S. looks like once the Federal Reserve gets out.
Yeah, I mean that was Steve's point, right? That it's a casino created by the various feds around.
Well, not
around
everybody acknowledges that, by the way.
But largely because of easy money, right? So that there was a lot of move into risk assets. The big question is, if he sees the market going down and he sees interest rates where they are going to go in his mind, does that mean deflation across all asset classes? And that's a whole new economic problem.
Keith, what do you think?
Well, to be clear, we have deflation across every asset asset class other than U.S. stock market in the last couple of weeks. So you had emerging markets crash, you've had China crash, you've had oil crash, you've had junk bonds crash. Deflation is probably the most obvious that anybody can stare back at and say, wow, that was a big factor. And when you don't have growth and you don't have inflation, i.e. you have deflation, what you end up with is a central planning panic. So I wouldn't call it a casino, I'd call it a panic.
All right, Steve Cortes, thank you for joining us this morning. You obviously provoked a very strong conversation.